Good morning, everyone. Good morning. Thank you so much for taking our time and joining us this morning. We have amongst us Mr. Paresh Sukhtankar, Deputy Managing Director, HDFC Bank. I don't think so he requires any more introduction, so I know you all are looking forward to listen more from him. So without further ado, I hand it over to Paresh to take it forward. Thank you, everyone. Thank you. Paresh, over to you.
Good morning, everyone. I know you have a full day of interactions only with financial services companies, and in some ways I guess this reflects the current mood of the markets, of all of us, where for some reason people don't seem to have as much confidence in the real side of the economy as they have in the financial services space. So I think we seem to be doing something right. That's a lot better. I'm going to try and keep this a little short, just share a few thoughts that I have, and I'll be happy to take questions because I'm not sure, what may be of interest to you, and I know that I see a lot of familiar faces, so I think we've met before. I'd be happy to take questions thereafter. But let me start off by saying that I too share this general optimism about the opportunity relating to the financial services space. We all understand that whenever banks, NBFCs or the entire financial services space tends to outpace the real side of the economy, you'll end up having some issues. But perhaps for two reasons that is unlikely to happen, at least in the short, medium and perhaps even long term in India. One, because as you have the economy growing, the real side of the economy growing at whatever pace, and we can argue about what the real, the new series, the old series, the real GDP growth is. But we've seen that the financial services industry in India tends to grow at a slight multiple to the real GDP growth. And that's because, ultimately the actual financial intermediation process in terms of at least formal intermediation is still at a relatively low level. If you look at all the parameters like credit to GDP or bank penetration, number of accounts, adults who don't have accounts, although all of these parameters have been moving in the right direction, there is still a long way to go. And therefore, as you have growth, clearly the effect of that in terms of trickling down of that higher income level or higher wealth creation generates need for formal financial services at whatever segment that you're talking about. And so it's not unreal to believe that certainly the banking services, the banking sector for instance, has traditionally grown at maybe something ahead of nominal GDP. If you see in the recent past, the growth rates for the banking industry in terms of loans and deposits having come down, it's probably a little less to do with the real GDP growth coming off from where it might have been, and more to do with the fact that clearly inflation levels having come down, the gap between real and nominal GDP, and therefore nominal GDP being, or the banking industry then being at a multiple of nominal GDP has collapsed a little. And which is why I think as against low or mid-teen growth in the banking industry in the last year or little more than that, you've seen a somewhat anemic high single digit, or 9-10% growth. And to some extent, as we've seen inflation bottoming out, and although it has other implications from a macro perspective, from a nominal GDP growth and a banking industry perspective, and for that matter therefore from a financial services industry perspective, I think in the next few quarters, in the next couple of years, certainly should see the benefits of both the cycle turning in terms of slight improvement in GDP and perhaps inflation normalizing a little. The other piece of course is the level of penetration in terms of just the sheer coverage in terms of customers. This has changed a little. I mean, you used to hear that 60% of adult Indians don't have a bank account or don't have access to any form of formal financial services, which meant that when it came to borrowing, for instance, it was family, maybe it was money lenders, it was manufacturer-linked financiers in some parts of rural, or whatever else that might have been, depending on again which customer segment you're talking about. And I think the plethora of players coming in, banks expanding, the government mandate in terms of the Jan Dhan Yojana and so on has meant that existing players have been much more focused in terms of reaching out to larger geography, and of course there have been many new players, and a lot of the newer players, of course, who are much smaller, have morphed into being more meaningful players, have started accessing formal streams of capital, and therefore the growth in players, again new and old, continues, and therefore that sort of has its own momentum in terms of financial services. So I genuinely do believe that the next few years should see healthy growth, or does offer good opportunities for growth for the financial services sector. That of course doesn't mean that unbridled growth by any individual player will always lead to success. Right? I mean, I think the financial services industry is one where the sales cycle really is not complete when you dish out a loan, but really the sales cycle itself is complete only when you extended a loan, that loan comes back, hopefully full principal and a little more than what you gave out, and that's when you really earn something for the bank or the lending institution. And to that extent, therefore, the need to balance growth with caution in terms of risk management and in terms of ensuring that your profitability is adequate or your margins are adequate to cover the risks that you're taking, I think is certainly a mantra that we at HDFC Bank have been very committed to. I'll just touch upon two other factors which I think may be relevant, and they're slightly niche, but all of us hear about this whole focus on digital, right? And banks talk about it every day. There's not a day that you open the papers and don't see some launch or some new feature that has been added on by various banks, fintech players and others in this whole financial services space. And again, there is no running away from the fact that in whatever manner, using technology, not just in terms of the back-end processing and so on, which has always been the case, but using it for understanding customers better, using whether it's your data warehouses, your customer relationship management tools, your analytics, to improve decision making in terms of both what products you want to offer the customer, the convenience that you are bringing to the customer, the fact that you are servicing the customer across not just multiple channels, but with a uniform experience across channels. So the customer may log into the net, might immediately thereafter access the phone or walk into a branch or whatever else, and he or she can actually continue with the same transaction almost where the person is left off. All of this and leading to significantly greater convenience to the customer, shorter turnaround times. I think all of this is now, one, becoming almost like a hygiene factor, pretty much the way that branches, in some ways gave way to higher usage on the ATMs, and you moved across the channels. So obviously there will be different pieces of, different features or different pieces of the digital pie that different banks access or different players access. But I think any player who, for whatever reason, is cynical about digital or says, this is nice for presentations and talking about it, but really doesn't make a difference, at the bottom of the pyramid. I think reality is that it would actually make a huge difference at literally every customer segment level. And there are obviously implications from a customer perspective in terms of how you service the customer, the convenience, the turnaround times, the stickiness, the product features, and for the institution itself, because doing it appropriately, leveraging digital opportunities does effectively reduce costs for the entity itself. So it's genuinely both a top line and a bottom line driver. Shifting gears from here, I just want to leave you with one other thought, and then I'll take questions. We all are heading towards IFRS, right? I mean, our version of IFRS, which is Ind AS. And the reason I'm just leaving this thought with you is because in many ways, this is a somewhat less explored, as yet less understood issue in terms of what implications it has. I think in the last quarter or so, we started seeing some of that on, manufacturing companies, industrial companies, and we're trying to grapple with what the implications of the change in accounting standards means for understanding financial performance for companies. And trust me, if that is a bit of a change, the changes for the financial services space in terms of India's accounting are going to be even more drastic. The whole concept of fair value accounting, moving on from a 90-day non-performing loan piece to figuring out how you actually look at non-performing, underperforming, and so on and so forth. I think this whole piece will, I think, unravel over the next year or two. By the time in 2018 it becomes operational. But I think in many ways it will change the way all of us look at banks in terms of understanding risks, understanding matching of revenues and costs. And I'm now going to sort of dive deep into this because all of us are going through that process of trying to, one, be in readiness. The impact on systems and so on are huge. You for instance have to reflect your loans not in terms of contractual maturities, but if there is a certain history of prepayment, you will start having to reflect those as across those tenors for certain purposes of revenue recognition. And effectively, therefore, the customer has a certain repayment schedule that is the legal contract, and from an accounting perspective, you're trying to relate that to what is the actual, based on the track record and the history, what the maturities are. So there are all sorts of complications in terms of implementation for the institutions, but what that really means in terms of your understanding and analysis of these companies, of banks and financial services companies, I think is certainly something that you might sort of want to start getting yourself familiarized with. I could sort of ramble on, and I know that I have been given 30 minutes, out of which I think we started 5 minutes late, so 25. I think I'm pretty much done in terms of what I wanted to share as a few thoughts. Maybe I'll just stop here, take a few questions, and please. Yeah, sure.
How do you think the ESOP accounting of IFRS will change the ESOP incentive structure in bank? And do you think that the salary cost or the salary cost should go up?
Yeah. So clearly, as I'm sure most of you are aware, under the Ind AS or IFRS, the option costs, as estimated, let's say by the Black-Scholes model or whatever else, will get charged to the P&L, right? Right now, if you in the current gap, if you were giving options, granting options at the current market price, there was no, the option value was not coming into the P&L. Two things. One, of course, whatever is the transitional impact will go through balance sheet, but obviously any options which are outstanding and as they vest, they will come into the P&L. For instance, in our case, this is something that we already do for US GAAP. So since both our Indian GAAP and US GAAP numbers are in the public domain, one can easily see what the potential impact of the option piece is in terms of P&L, assuming we kept things exactly the way they are. I think your question, does that in some way change the way that that banks use the tool of options? Well, I think there may be some tweaking of the use of the tool. I think we've done a lot of work on that in terms of our own, sort of using that tool, leveraging that tool, and we find that it's been an extremely powerful, device, a framework to not just reward but retain, team members across the board. It's also true that perhaps institutions like ours have been much more widespread in terms of the coverage. and there are some institutions which are slightly narrower in terms of coverage. So I think each institution will go through its own assessment of the absolute costs that they are willing to absorb, vis-a-vis, whether you want to really cover only the movers and shakers, do you want to cover, a slightly wider sort of size of the team. So my feeling is that will options remain in whatever form? Absolutely. Could there be some changes in the absolute impact or the sheer levels at which you sort of continue? Probably.
It's a very popular.
Can I take one and then come back to you?
Sure.
Yeah, good. Yeah.
Paresh, Nandan has been writing a lot about how this whole digital banking will have an impact on traditional banks. Just your thought on what happens when unified payment interface comes through crowdfunding. Are these just things in the cloud, or does it really have an impact on banks like yours?
So I think the fact that a lot of these newer, whether it's a pipe which allows you to make payments across bank accounts, or any sort of a change in the financial infrastructure, if you might, or new products, will that in many ways change the way individuals transact or how payments are made and so on? I think that's a reality. Does that mean that incumbent banks will get impacted? Is there a huge disruption? I think that's really a function of how each player is going to position, himself. Today, a lot of the innovation or a lot of the adoption of various, digital conveniences or digital features are actually being done by the banks. And of course, there are other players who are non-bank players, whether they are wallets or there are other players who have also looked to cater to and provide these conveniences. So I think it's really the use of the technology and adoption of the technology and so on, which is what is going to make an impact, rather than saying that this segment or that segment of the industry will or will not. So I think those players who, for instance, if you are a customer and your bank does not offer mobile banking or does not offer you the convenience of being able to do a P2P payment on your mobile or some other such convenient device, you would probably continue to have your bank account with that bank maybe, but might switch to or also take on a non-bank wallet, or might download an app which again permits you or enables you to make a payment and so on. And you would therefore in some ways at least have shared your wallet from a banking or a financial services perspective. But on the other hand, if your bank offers you everything including the traditional account with your checks and your tellers and everything else, but also is offering you the entire suite of products on the net, on the mobile, has a wallet which allows you a one-click payment. In fact, is probably a superior wallet simply because unlike in a non-bank player's wallet where you need to pre-fund the wallet, a bank has the ability to give you a wallet where you can actually draw the money from your existing savings account or use your credit card by linkage. At the same time, it's a one-click experience and so on. I think that can make a difference. Similarly, with the UPI, like you mentioned, if your bank is not offering you some of these features, you could stick with your account there but still download another bank's app and make the payments through that bank. So I think it's not a black and white whether existing or new players will have an advantage. Players which adopt this, the moving technologies and are innovative, will certainly retain, if not increase their hold over the customers. And others, so it's a risk of where you are in that whole system. Having said that, I think we've got to realize that this whole focus on this proportion of transactions are going through this channel or being done this way gives you perhaps an indication of how people would like to transact, but really revenues don't move with transactions. Revenues actually move with static money. Right? So after you made all these transactions, where the floats remain or where the balances remain is where you make money. So merely because somebody starts having, hundreds of thousands or crores of transactions, does not by itself, generate a revenue model. Unfortunately, all of us, are terrible at paying fees for transactions, right? So, unless you can monetize those transactions, all that information about the transactions, all the customer and so on, I'm still a little hazy about how this whole thing will. There is a huge opportunity, and I think people will take to those. I'm sure any of you who've got kids who are now in their teens know that they might never have gone into a branch of a bank at all, but and hopefully will they probably will not want to. Want instant gratification, not just on transactions and payments, but on loans and so on. So I think that I'm fully with you. But this entire doomsday scenario is probably, and what do you expect me to say anything otherwise? I think, if at all, one last question, otherwise I think, we are running.
Increasingly what we find that banks are initially they would use microfinance institutions as intermediaries for the PSL funding, etc. But now increasingly we find that the proportion which the banks are directly dealing with this segment or through BCs is continually increasing. So how do you see this trend, and how does it be impacting the microfinance sector?
So I must confess, Shumit, I'm not sure what the entire system is doing, but I can certainly speak from our experience. And I think you are bang on that maybe it was 8-9 years back that we started actively lending to or accessing this segment, and we clearly did that through the wholesale route of lending to microfinance institutions. And it just made sense to play to the strength of each institution. Banks tend to be larger, somewhat clumsier in terms of accessing a smaller customer. That's been the traditional sort of positioning. And clearly, grassroots institutions which were close to the customers and had a model which worked were the best route to lend through. I think a couple of things changed that. One, I think clearly the experience that banks had during the entire AP scenario, put off banks, because clearly, all of us took some knocks, small or big. And to that extent, therefore, although these were traditionally seen as very safe institutions with very low, non-performing loans and highly, if you really had the benefits of diversification at a customer level, clearly you had them in MFIs. Although we saw that the concentration risks of geographical concentration, played itself out. So one, I think there was a slight bit of a jolt in terms of banks, the way they saw MFIs. And in our experience, we also felt that it was important for us to understand the business when you are lending to somebody who does that business in the financial services space. We wanted to be there ourselves, and we figured that we would want to start experimenting with or piloting some lending, on a microcredit basis. And we initially did that through the BC route, and again there we had mixed experience, but we certainly had an experience where the operational risks, the fraud risks, and the fact that the BC ultimately, because he has the contact with the customers, can actually hold you to ransom, and if there is any malfeasance on their part, you really don't have the same access to the customers. And which is why we actually moved to building what we call the Sustainable Livelihood initiative of ours, where we've actually grown this business with our own employees. And if today we have about 80,000 employees in the bank, almost 7,000 of those actually are part of this SLI business of ours. Although that probably won't even be, in fact it is less than 1% of our loan book. For us, of course, it's also an element of social responsibility way before the CSR piece came in, because we're not interested only in the lending piece. We do a lot of effort, we put in a lot of effort in terms of the financial literacy, the capacity building, the market linkages, the whole host of stuff that we do, which is not part of the traditional lending business for any bank. And that we believe is part of our contribution to the community, and it's part of a board mandate to enable 10 million households, to improve their livelihood. So I think you would, and I think different banks have therefore invested in different ways. So to my mind, if a bank is really serious about it and is willing to put in its financial might and not just lip service, because you know how it is trying to get to convince yourself to hire 50 more people for a particular business, and to have done this in thousands requires a level of commitment which is different. But if you are willing to do that, then I would say that banks would maybe willing to invest that. I don't think you will have too many banks doing that, and I think therefore banks will probably continue doing a bit of both, maybe in some ways just flirting with this directly, a few players being serious about it, and many more players continue to deal through MFIs. Of course, I think this whole thing about getting PSL from MFIs has become difficult because all of you guys have become banks yourselves. So not much left for us. Thank you so much. Appreciate your patience.